percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
The Federal Reserve ordered another big boost in interest rates on Wednesday and warned that rates will have to go even higher to bring stubbornly high inflation under control. The central bank raised its benchmark interest rate by 0.75 of a percentage point. The rate, which was near zero in March, has jumped 3.75 percentage points in the last 8 months. That's the most aggressive string of rate hikes in decades, but so far it's done little to curb inflation. Interest rates have risen at a whiplash-inducing speed, and we're not done yet, said Greg McBride, chief financial analyst at Bankrate. It's going to take some time for inflation to come down from these lofty levels, even once we do start to see some improvement. Annual inflation in September was 6.2%, according to the Fed's preferred yardstick, unchanged from the month before. The better-known Consumer Price Index shows prices rising even faster, at an annual rate of 8.2%. Fed Chairman Jerome Powell warned that taming such severe inflation will likely require even higher interest rates than he and his colleagues had predicted just 2 months ago. "What I'm trying to do is make sure our message is clear," Powell told reporters Wednesday. "We have some ground to cover with interest rates before we get to that level that we think is sufficiently restrictive." At the same time, Powell said the pace of rate increases may soon slow, as policymakers take stock on the effect higher borrowing costs are having on the economy. "That time is coming, and it may come as soon as the next meeting or the one after that," Powell said. Stocks initially rallied at the hint of smaller rate hikes in December or January, but soon sank at the prospect that rates will ultimately have to go higher. The Dow Jones Industrial Average fell more than 500 points, or 1.55%. The broader S&P 500 index fell 2.5%. McBride argues that in order to curb inflation, borrowing costs will likely have to remain elevated for an extended period. "The mantra for 2023 is higher for longer," he said. "When inflation's been running at 6, 7, 8% and the target is 2%, it's going to take a while. Rate hikes are having an effect, even if inflation remains untamed. Higher borrowing costs have already put a big dent in the housing market. And other parts of the economy are beginning to slow. But consumers, still flush with cash saved up early in the pandemic, continue to spend money. As a result, the Fed may have to tap the brakes harder, for longer, than it otherwise would. We see today that there is a bit of a savings buffer still sitting for households that may allow them to continue to spend in a way that keeps demand strong," said Esther George, president of the Federal Reserve Bank of Kansas City. "That suggests we may have to keep at this for a while." Like her colleagues on the Fed's rate-setting committee, George has expressed a determination to control inflation. But she's also cautioned against raising rates too rapidly at a time of economic uncertainty. "I have been in the camp of steadier and slower rate increases to begin to see how those effects from a lag will unfold," George said last month. "My concern being that a succession of very supersized rate hikes might cause you to oversteer and not be able to see those turning points." With polls showing inflation is a top concern among voters, the Biden administration and most members of Congress have stayed out of the Fed's way as it tries to control prices. But a handful of Democrats have begun to challenge the central bank's approach, warning that aggressive rates hikes could put millions of people out of work. "We are deeply concerned that your interest rate hikes risk slowing the economy to a crawl while failing to slow rising prices that continue to harm families," Senator Elizabeth Warren, Democrat Massachusetts, and colleagues wrote in a letter Monday to Fed Chairman Jerome Powell. The housing market has already slowed to a crawl, as mortgage rates top 7% for the first time in 2 decades. Kansas City homebuilder Sean Woods said his company has gone from selling a dozen houses a month before the Fed started raising rates to fewer than 5. Never in my wildest dreams would I have thought we'd go from 3% mortgage rates to 7% within 6 months, said Woods, president of Ashler Homes and the Home Builders Association of Kansas City. I think we're in for a rough 6 or 8 months, Woods said. Typically, housing leads us into downturns and it leads us out of downturns. And I think from a housing perspective, we've probably been in a housing recession since March or April. Despite the fallout from rising interest rates, Powell said the central bank has a responsibility to bring inflation under control. No one knows whether there's going to be a recession or not, and if so, how bad that recession would be, Powell said. Our job is to restore price stability so that we can have a strong labor market that benefits all over time.
Well, I appreciate the offer, and I do recognize this is a U.S. government debt, and so they're good for the payments. But I'm a little, I'm afraid, put off by the interest rate, because I have one right here that's offering me 12.25%, just been issued, brand new issue. Inflation is higher. Investors need to be compensated for that inflation, so interest rates have gone up. So I'll buy your bond, the old bond from you, but for less than $5,000. I'm fine with that.
This is why when interest rates go up, back in the 70s and 80s, now bond values, the bond market, goes down.
Yes, the way to think about it is that the interest rate being offered on new bonds is higher than on the old bonds. So you need the yield to match in order for people to be willing to buy the old bonds. Otherwise, they're just going to stick with the new bonds. For that to happen, the price of the old bonds has to go down.
Okay, but that doesn't explain why stocks also sank as interest rates rose. Robert Merton won a Nobel Prize for his work in finance.
The King of Sweden gives you the gold medal in a case.
He's been teaching about stocks for decades.
Here's a share of stock. And why does it have value? It has value because you have rights to the current and future earnings of the firm.
Why are stocks going down now?
To understand stocks, you have to understand the three elements that enter into their value or their change in value. First is the earnings. Everything else the same. The higher those earnings, the more valuable. A second factor that affects value is, are the earnings going to grow from here? That would be good, makes it even more valuable. Or are they going to decline or stay flat? Makes it less valuable.
But you said there was a third factor.
The future earnings on stock are risky, unknown. The future payments on bonds are known.
Right.
To compensate people for taking the risk of uncertainty about the future earnings of the stock, they have to be compensated with a higher expected yield or return than on bonds.
I ask you, why have stock prices been going down? You say to me,
concerns over possible recessions in the future. We know that the Fed is purposely trying to raise interest rates to cool the economy down, so we know there's a greater chance that we might have a recession, which means lower earnings, and competing rates, greater uncertainty, the impact of inflation, all those things. You put it together, it's not a surprise, but the question is, what will they do tomorrow? It depends on what new information we have compared to what we know today.
Yeah, I did a little research for some numbers, or some basic numbers. I'll do this really quick. Right now, let's say someone was buying a $500,000 house. That's it. And you're going to do a 30-year fixed, and you're going to put 20% down. So standard deal. In March of this year, you would have had a 3.5% mortgage or an $1,800 payment. Reasonable, for a family. Right now, at 7.5%, that's $2,800, up $1,000. At 10.25%, where you and I both think this is going, it's double, $3,600.
Oh, it's going there.
So the buyers are being crushed. Now let's go the other way. Let's say the $1,800 was all that I could afford as a buyer. When the interest rate's at 7.5, the $500,000 house I can afford, I can only afford a $325,000 house. So my buying power is down almost 40%.